I'm going to be talking about the subject investing. It's going to be a very informal session, but it is my hope that you find some ideas and some perhaps strategies and some concepts as part of this series that you can use to help you achieve your financial goals and your financial dreams. And if for whatever reason you're not really into investing and you're not really into wealth or increasing your financial scorecard or scoreboard, I will like to think that what I share in the next few minutes will still be very useful. And so for that reason, I want to just ask that you be patient and just stay with me and just listen. In many ways, sometimes it's not that we don't have the right ideas. In many cases, we already have the ideas. We know what to do. But every often, we need someone to come along and either encourage, remind, or probably motivate you, or even inspire you to take action on something that you already know how to do. So for those of you who already are familiar with the concept of investing, you might find this to be still very useful, because I'll be reminding you of what you already know, and I might be presenting it or talking about it from a very different perspective. And I like the concept of a coin. I always use this concept that every coin has three sides. Not two, but three sides. There is no such thing as a one-sided coin. Likewise, there is no such thing as a two-sided coin. Every coin has three sides. You have the heads, you have the tail, and then you have the edge, which is the third side. And intelligence is found in having the ability to stand on the edge. Because when you stand on the edge of the coin, you can look to both sides and you can see two different perspectives. As a matter of fact, Scott Fitzgerald said that the sign of first-rate intelligence is the ability to hold two opposing ideas in the mind at the same time and still retain the ability to function, which simply means, can you stand on the edge and look at two perspectives? So for those of you who are probably a little bit more advanced, I want you to just stay with me as well, because you might find that it's a different perspective that I'm going to be bringing across in these few sessions as we get started. Now, having said that, I have an objective in mind. My objective from this session is simply to provide you with three what I call sub goals. Number one is to increase your understanding about investing. It's a subject that most people don't understand well, and part of the reason is because it's not explained very simply. My second objective, once you've understood a little bit more, will then be to show you specific strategies and specific action steps that you can adopt and you can start applying immediately. You don't have to wait for 2021, you don't have to wait for 2050, you can start using them right now. And number three will be to give you a platform or pathway to assess your results, because at the end of the day, results is the name of the game. You can talk philosophy, you can talk about positive thinking, you can talk attitude, you can talk strategies, but at the end of the day, the results you create, the results you produce is the name of the game. So I'm going to be showing you how to review your performance, review your activity, and look at your results, and how to then use those results as a way of guiding you on what to do better or what to change. In most ways, it's not that you're not really getting results, it's that when you get your results, very few of us stop and say, what does this result tell me? And I'm going to be showing you how to analyze your results and make strategic changes. I often say that you want to ask yourself a few questions when you get your results. You want to ask the first question, what have I done? Number one. Number two question you want to ask yourself is, what is working? Once you've identified what's working, then it's something you have to build on. Number three you want to ask yourself is, what is not working? And that should identify something that you should stop doing. And number 4, you want to identify what is it that I haven't even started doing. So we're going to go through various parts of the investment process, and I hope that you find it interesting. Now let me start with this. Going back to the coin analogy, you can use that coin analogy to explain the process of investing. Wealth, I call one side of the coin. Investing, I call the other side of the coin. In order to create wealth, you have to invest. So in many ways, the reason for investing is to create wealth, to build wealth, to multiply wealth, to maximize wealth, to protect what you've created, like to nurture the soil that you've created, which is your wealth garden. So part of the reason you invest is because you want an outcome. Investing is, in my opinion, is really what I would call the cause. The effect of investing is then wealth creation, because that's where you get the seed and the results and the harvest. So the first place to start with investing is to understand that you mustn't focus on what investment vehicle, what investment strategy and what investment option to begin with. I'm going to go back to the basics. It's so simple. Whenever you have a transaction between two people in the process of investing, there's always something that you must bear in mind. And I think this is probably the most fundamental part of the investment process. And this process is simply this, that whenever someone is buying, as part of a transaction, you have someone else selling in a transaction. And therefore, to create wealth and to be a good investor, you must recognize that the person buying is buying believing that what they're trying to buy, the asset they're trying to buy, is going to go up in value. The person selling is selling believing that the asset has already reached a certain value and therefore it will go down in value. Now, one of you is always right. Now, the first thing you want to do when it comes to investing is you want to be the person on the right side of that equation. Transactions happen between two people or two parties. In many ways, depending on the category of investing you get into, many of them are what we call a zero-sum game. I'll give you a good example of what a zero-sum game would look like. It's like going to Vegas or going to play the slot machine, going to a casino. The house always wins, and the reason is because the odds are designed to suit the house. You might think I've just won 1,000, 2,000, 2 million, but for every time you play a card, the house has designed the odds in such a way that they make a percentage profit. Therefore, we would say that gambling or playing the lottery or maybe even going to the casinos is a zero-sum game, that when one person is winning, someone else is losing. Now, in many areas of investing, it's not that clear-cut. There's some parts of the investment process whereby not everyone loses. Maybe you invest in a particular company, therefore the company benefits, therefore the shareholders benefit, and therefore you benefit as well. So, but the principle is this. Now, whenever you're investing and you're buying an asset, the person you're buying from is selling, believing that the asset is going to go down. You are buying with the hope that the asset is going to go up in value. Therefore, you have to be the person on the right side of the transaction. And there's a process that you have to follow to make sure that you're on the right side. That is the first concept to invest in. Now, let me begin by laying a foundation. My background is engineering, building, design, and construction. And if you were to speak to any contractor, architect, or engineer, they'll tell you that the most important part of every building is the foundation. You can design a really beautiful building, and if at the end of the construction process, the surveyor identifies, or the control inspector identifies that there is a severe defect on the foundation, that building will be rendered inhabitable. Therefore, the building might even be pulled down. On the other hand, you could create a foundation that is robust and you notice a crack on the wall, maybe on the 12th floor. All you have to do is repair that part of that structure. repair that wall. You can reinforce within that particular area where you find a defect. So the foundation is the first part of the investment process. And this begins by you sitting down very quietly. And this is not something you do by consensus, by group decision. You have to decide for yourself. And that process of building the foundation starts with a question. Why are you investing? Now, this sounds very simple, I know. But I can promise you that as much as I've tried to interact with people from different walks of life, I have almost certainly rarely met anyone who has a very clear distinction as to why they're investing. So the first step in the investment process, I would always say, is to begin with questions. That's how you set the foundation. Let me use this analogy as a way of explaining the process. Let's imagine that you're in central London and you were going to travel from central London to Manchester in England. You would have to drive. Let's say you've never driven from London to Manchester before, and the car you're going to use has a GPS system. When you get into the car and you're about to leave, the first thing you have to do when you put on the GPS system is to insert your desired destination. You have to put in what we call the postcode. You have to put in the address. Depending on where you're watching from, it could be a zip code or it could just be a normal address. But you have to put information about your desired destination. So the first part is understanding, what is my destination? What am I trying to achieve? Where am I trying to get to? And once you put in the destination, what happens, which is quite interesting, is that the GPS system then uses your present location to identify and calculate the preferred roadmap or the route to get you from where you are to where you want to be. So the second step is to have an understanding about where you are. You have to know your location. Once you've identified your location and you already have your destination, then you have a roadmap. Interestingly, the GPS system will give you options. It never gives you just one option. And that's the most important thing you have to understand in this process as we go along in defining the foundation. Anyone who comes to you and says that the only way you can make money or create wealth is through this particular investment process or strategy or vehicle is lying. The person is lying. The GPS will give you options. It will tell you, you can go through option A. This will get you to Manchester the quickest. So there's a fast route, but there'll be consequences. One of those consequences could be that it takes you through maybe the motorway road, the main major roads, and therefore you don't get to see part of the city. It takes you off maybe the main attraction route. It might give you another option where it says, well, if you would like to go through a route where you have service stations and you have maybe places where you can stop, then it gives you a different option. So there are different options it can give you. Depending on what time of the night you're traveling, it could give you an option where it says that, well, there are hotels along the path, along the way, in case you want to stop and spend the night. Therefore, it comes down to, number one, what time of the day you're about to leave from London to Manchester. Number two, it depends on what type of vehicle you're using in terms of what type of car are you using. It also depends on, for example, do you have enough fuel in the car to go all the way to Manchester without stopping? Because if you, for some reason, chose the fastest route where there were no petrol stations, what happens if halfway through you run out of gas? Now, all of these can be translated into personal questions. For example, what time are you leaving from London could be, how old are you? Because your age should be a critical factor in choosing an investment vehicle. If you're 65 and you're trying to invest, your investment process should be quite different to someone who is 25. Why? Because investments have different levels of risk and the return on investments vary. No two investment vehicles or investment strategies provide you with the same results. So you have to ask yourself some questions. One of those questions I talked about was, do you have enough fuel to take you from A to B? If you translate that into your personal life, that could simply mean, do you have enough money in terms of liquid cash set aside such that when you put your money into an investment vehicle, you don't have to worry about getting it back in the short term. Now, this is critical, very important, because, for example, if you invest in property, properties are very illiquid, and that simply means you can't just sell your property the next day. So we call them illiquid investments. It takes a while. You can buy a property today and you want to sell it. It could take you months, even years, depending on the value of the property and the location. So they're quite illiquid. You may not be able to pull out your money immediately. On the other hand, if you're invested in what we call the stock market, and I'll explain what all of these mean in the later sessions, but if you're invested in the stock market, it's more liquid. And that simply means that if there is a market where you have a buyer and a seller, you can buy and you can sell your investment asset or stock more easily. However, because markets go through cycles, there are times when your need for cash coincides with what we call a market decline, a bear market, where the market is down. Therefore, if you were selling at that point in time, you could be taking a loss. You could have bought at, say, £10 per share. The market is going down and the share price is £2. It would be wrong for you to sell, even if you needed money at that point. So the whole concept I'm trying to explain here is this. Before you leave from your location, you have to ask yourself a series of questions. And these questions enable you start to formulate answers that help you build the foundation of your investment portfolio. Effectively, these answers are what we call ingredients, what you use to mix the sand and the cement and the steel beams and the rods to build a foundation. So those are some questions to ask. Let me go back. I said that one of the first things you have to do is start with the foundation. You have to ask yourself a question: where am I trying to get to? Meaning, what is my vision? What is the vision that I'm trying to achieve in the future? What is my investment target? Now, the second question is then, where am I right now? Where am I presently right now? And that is a question that perhaps you might want to share with preferably a financial advisor, someone who can look at your financial position and tell you, well, how deep you are, if you're in a pit already, or how secure you are. So you want to know, where am I? Because your location, your present location, determines the total duration to get to your destination. Let me put it in a more simple way. If you were traveling from London to Manchester, it could take you about 3 hours if you were driving. If, on the other hand, you were traveling from somewhere like Cheshire to Manchester, because Cheshire is closer to Manchester than London is to Manchester, that could take you roughly about 40 minutes. So where you are, location-wise, determines how quickly you get to your destination. The only way you can understand where you are is to do what we call a detailed analysis of your financial position. You look at what we call your assets, you look at your liabilities, you look at your income, you look at your expenses, you prepare financial statements, you prepare a wealth statement, and it tells you how much you owe and how much you have. Anyway, let me not go into the detail of this because we'll cover this in the sessions to come. Now, once you've identified your location and you know where you're trying to get to, it's then a question of saying to yourself, okay, what vehicle do I choose to go from A to B? And there will be so many ways that we go through this process. So you don't have to be worried about, would I make the right decisions? Or is the time going to be right? Or am I sure? Am I confident I know what I'm doing? Believe me, anyone can be a good investor. As a matter of fact, as we go through the sessions, one of the things you realize is that it requires less intellectual ability or IQ and more emotional control and stability. So I always say that investing is like a crossroad. It's like an intersection on a crossroad where you have psychology intersect with economics. So the economics is, when to buy, where to buy, what to buy, and how to do valuations. How much do you pay? Those are all economics, macro factors. What is the inflation rate? What is going to be my return rate? Those are all what I call economics. The psychology, on the other hand, is what I refer to as behavioral psychology, which is how do I control my emotions? What do I do when the market is going down? How do I think? But also, how do I think independently? It has to do with negotiation. It has to do with you being able to manage your mind. Those are all psychology. So if you have good emotional control, if you have good psychology, what you find, if you have good temperament, you will make a much better investor than someone who has high IQ but can't control their emotions. So we'll go through that in the later sessions, so don't worry about that. But let's come back to what we started with, and I'll summarize today's session. I said the first part of the investment process is to begin with an understanding that in every investment process, you have a buyer and you have a seller. You could be on either side, depending on what you're trying to achieve. You always want to be on the right side, whether you're buying or you're selling. And there's a process, a very simple step-by-step process that you have to go through that guarantees that you will be on the right side or that you will not lose money. And I said the first part of the investment process for you is to start by laying the foundation. That process begins by defining your vision. Say, what do I want? What am I trying to achieve? Where am I trying to get to? Then you have to be aware of where you are in terms of your present financial position. Then once those two are defined, you can come up with a process of saying, okay, I'm going to use a particular roadmap to take me from where I am now to achieving that goal. That process is what I call the investment journey. And I'll show you how to take that journey one step at a time. It's very simple, but it's very powerful. I hope that's been useful. That's all we're going to cover for today. We're going to begin in the next session going into the detail. I'll take you through a step-by-step process. I'll show you how anyone, and I mean anyone, can become a good investor and can achieve their financial goals and dreams.